and welcome back to the 50-Day Property Challenge, brought to you by EDPF Property Academy and Private Property. Today is day 15, and we've again asked our challengers to watch the videos we've created on property investment fundamentals while going out in search of their first property in this challenge. Enjoy session 3 as we teach you all about property investment strategies.
Good day all property enthusiasts, and welcome to the third edition of Property Investment Fundamentals, brought to you by the Enterprise Development Property Fund. I am Nigel Adriaanse, your host. I'm also the founder and CEO of the Enterprise Development Property Fund. Again today we come to you from our incubator here in Pinelands, Cape Town, and we'd like to present a few topics related to your property investment that you are going to make in the next few weeks and months and maybe even years. Over the last two sessions we spoke about principles of financial freedom, and the next thing that we spoke about was successful property investment. Today we'd like to touch the topics of strategy, area, property, and finance. These four are critical, and the understanding of them are critical for you to start or develop and grow your property portfolio. So let's jump straight into it, and in the discussion about strategy, let's talk about sourcing and flipping. Now, in order for you to start or grow your portfolio, the first thing you need to understand is what is your strategy. You need to know exactly which strategy you're going to use when you build a property portfolio. The reason that you need to know what strategy you're going to use is, especially if you have investors, is that when you want to build a portfolio, you need to understand what it is you're doing. You need to understand what type of property you're going to invest in. And based on that type of property, what strategy you are going to use in order to build or grow your portfolio. There are many, many different strategies. And like I said, the first two that we're going to discuss is sourcing and flipping. Now, personally, I do not use either of these two strategies. And the reason I do not use these strategies is because I believe they are the two riskiest strategies that there are. Sourcing is when you go and find deals, you structure the deal, and then you on-sell the opportunity to someone else. That you do not yourself take on the opportunity, you do not invest, you do not buy that property, but you put the package together, you put the deal together, and then you go and you on-sell it to someone else. Now, the reason I think this is a risky strategy, even though it is probably the easiest strategy, the reason I feel it's the riskiest, one of the riskiest strategies, is because of the property practitioner's bill. Within the bill, they speak about anybody who is involved in the sale of a property. This will include developers, estate agents, brokers, whoever, anybody who earns an income off the sale of a property. Now, if you are one of these people, you have to be registered as a property practitioner with the Estate Agencies Affairs Board. Now, remember this very, very carefully, because if you don't understand this, you may get yourself into hot water with a regulatory authority called the Estate Agencies Affairs Board. As a sourcing agent, what are you effectively doing? You are finding deals and you are on-selling the deal to somebody else. Now, you can do this in many ways, but in the main it could be considered, and I'm saying could be, it could be considered by the Estate Agencies Affairs Board that you are an agent and a real estate agent. Now, as a real estate agent, you cannot collect commission from a sale. And that sourcing fee that you take could be considered by the Estate Agencies Affairs Board as commission. Now, when that fee is considered commission and you are not registered as a property practitioner, you will not be able to collect your commission from the attorney. In fact, the attorney by law is not allowed to pay the fee over to you. Now, there are ways in which you as a sourcing agent can actually get your money without having to declare it as commission, or where it may not be considered to be commission by the Estate Agencies Affairs Board. Now, one of the ways that you can do this is where you actually become a party to the agreement, where you take a stake in the business that purchases the property. Now, as such, you then become a shareholder, and in the fact that you are a shareholder, there is no commission payable. You will then take a profit either of the rental income or the sale of the property at a later stage. Now, that is one way that you can become a sourcing agent without being considered to be a real estate agent, and therefore not be considered to have taken these fees as a real estate commission. Now, that requires some structuring, and I would recommend, if you decide to go and become a sourcing agent and in that way build your property portfolio, that you structure this very carefully with your attorney. And also talk to your tax consultant, because it is important that you, when you build a property portfolio this way, that you build it in such a way that you pay as little tax as possible, because you could end up paying an enormous amount of tax if you become a sourcing agent. Now, how you can build a property portfolio using sourcing is where you then become a part of the business. You take a 5, 10, 15, 20, 25% stake in the business for finding the deals, packaging it, and then on-selling it to a company. You become a part of that company and take a stake in that business. Now, once you've taken that stake, you now own 5% in that property, or 10 or 20 or 50% even sometimes, in that business, which then means that you have that percentage in that property. When you then do another deal, you then grow your portfolio by another 5 or 15 or 20 or 50%, and so on and so forth. And as you bring more such deals into a portfolio, you can actually enhance and grow your own property portfolio, because you have sourced deals, you have packaged it, and taken a stake in that business, where you are not taking a commission, but you are taking the fee in the form of shares in the business for what they call sweat equity. Sweat equity is where you put in time and effort into building a property portfolio, and as such you have the right to take a stake in that business. Now, in that way, using the sourcing methodology, you can then start to build your property portfolio without any of your own money, just your time and your effort. I personally do not have the time and the energy to build a property portfolio this way. I would much rather use other methods. But for you, if you do not have the money or the infrastructure or the connectivity with people to build a property portfolio this way, in any other ways, this is probably the best way to do it. But just be careful that the Estate Agencies Affairs Board do not look at the income that you receive as if that income is real estate commission. Talk to your attorney, talk to your tax consultant, and talk to your accountant to make sure that you structure it properly. The second one is flipping. Now, this is a very interesting way of building a property portfolio, because what you do here is you don't actually hold on to any assets. You buy an asset, you buy a property, You do some renovations, maybe a bit of painting, spit and a polish as they call it. You lay some tiles, you put in new basins, you put in a new shower maybe, you repaint it, you maybe change the roof, maybe change the ceiling, maybe some windows. Do some repairs and maintenance on the property so that you can take the property from maybe a derelict state into a good state that you can on-sell. Now, in the main, people who do flip deals will look for distressed properties, properties that are not in a good state, or derelict as I call it. Then they take that property and they fix it up with their own money, or sometimes other people's money, where they either bring in partners or get an equity partner, lend money from the bank, whichever way that you choose to raise capital. And we'll talk about that in the fourth pillar of this discussion, where we talk about finance and how to finance your property portfolio. You bring the money in, you fix up the property, and then you go and you sell it at a market-related price, therefore making a profit from what you've bought to what you have sold. Now here you've got to be very careful, and the reason why I do not like to invest in flip deals myself is because of the heavy risk related to flip deals. The risk here, and bear in mind here, I'm talking to you to make sure that you understand the benefits, but more importantly the risks. Because if you understand the risks, you can mitigate those risks by taking certain precautions. So listen very carefully at the risks within every one of these strategies so that you can mitigate those risks and then hopefully come out at the end with a positive outcome. So the risk in flip deals is that you buy a property. Let's say you spend R1 million by buying this property, but the market value of the property, and you've made your money up front, as we've spoken about before, you've made your money up front, the market value is 1.5 million, and you've managed to pick up the property at R1 million because it's a distressed or derelict property. So now you have this property, you bought it for R1 million, you spent 80,000 Rand on your legal fees and other costs. So now you still have 420,000 Rand worth of value as it stands, with the market value being 1.5 million. Now what you do is you look at the property and you say, okay, what can I do to fix this property? And maybe spend another 100,000 Rand on fixing it up, spit and a polish, as I said, do some paint work and so on and so forth. Now you spent 180 on the property, but bear in mind originally the property was worth 1.5, but now you've done a little bit of work and you've made the property worth more than the 1.5. Let's say you've just added the 100,000 Rand value. You now have the property at 1.6 million. Now you go back into the market, maybe 3 months later, and you sell that property and you make a profit of between 1.6 million. Let's say you then sell it at 1.6 million, and you've spent 180. You've made 420,000 Rands worth of profit. The danger here is that the markets turn like it has over the last couple of years, and COVID happens, and all of a sudden there are no buyers in the market, and in fact even worse, there's a lockdown so nobody can move. So now you're stuck with a property. Not only that it's empty because you haven't thought about maybe renting it out, moreover you're stuck with this property where you've got debt of 1,180,000 Rand that you now have to repay. But the markets are dead, there's a lockdown, and you can't fill the space and get rental. You now have to pay between 10 and 12,000 Rand depending on what the bank has given you as a loan and what interest rates you're paying. You now have this debt that you have to pay back every single month, and you don't have the money. So the way to overcome this is, and the way to mitigate this risk, is to have alternative strategies. The first alternative strategy that you could use is to make sure that there's enough money in the kitty that from the investment that you've put in, that you are able to pay back whatever loans you've taken for at least 6 to 12 months. because in this period, you are almost certain to be able to sell. Sometimes you'll even want to extend that to 18 months if the markets are really bad, and make sure that you have enough money to cover all your debt. The second option is to not take out any loans, but to get investment partners in so that you don't have any debt that you have to repay on a monthly basis. So therefore, the only risk that you have is that it takes you longer to repay your investors. The third option is to make sure that you have somebody that is ready to tenant the place. So if you have a tenant, at least the tenant will pay back the debt that you have, the bond that you have, and all the other costs. Things like your municipal costs, maintenance costs, etc. So those are just 3 strategies that you could use if you decide to go the flip route. And in fact, in any strategy that you use, whichever strategy you use, always make sure that you have different strategies in place from a perspective of either having rental income or having a sale opportunity or having enough money in the bank to cover whatever costs you have. Never allow yourself to get into a situation where you have to repay debt and you don't have the money. Always have an alternative exit strategy. All right. Let's talk about the next 2 topics, or the next 2 strategies. Buy-to-let and multi-let. Now they're basically the same, except that in the one case, you are buying to let to an individual or to a family, and in the other case, in multi-let, you are renting out to multiple people that are not related to one another. So in the straightforward buy-to-let, you are buying a property. Whether you renovate it or not doesn't matter. You then let it out and get rental income. Simple strategy. It's probably the most simple strategy that there is within the property sector. You buy a property, you rent it out. Simple. The difficulty obviously comes in if you can't find a tenant. That is why research is so important. You need to understand the market that you are in so that you know that you are always going to have a tenant. Make sure that there is demand for rentals in that area that you are going to invest in. In any strategy that you use, you always have to know that the target market, whether it be families, whether it be individuals, bachelors, single people, whether it be students, whether it be a commercial property, whether it be a retail property, office, or industrial, whichever strategy you choose, make sure that you have done your research in terms of the demand for that particular type of property. So, the risk mitigation for a buy-to-let strategy is research, research, research. My personal risk mitigation that I use is using real estate agents or property management agents who know the area, who work in the area, and they will then manage my property for me. Because our investment portfolio is so diverse, we cannot be everywhere. We need to have people that know that particular area that will rent out our place for us. Then the next one, which could become quite expensive depending on your risk portfolio, etc., is insurance. Taking out rental insurance. So that if anything goes wrong, and for whatever reason you cannot find a tenant, that at least you are covered for a few months in order to receive rental income, because you've lost a tenant or something bad has happened, the property has fallen apart, there's been an earthquake, whatever the case may be, that you still have income to cover your debts. Now, like I said, the difference between a straightforward buy-to-let and a multi-let is that on a straightforward buy-to-let, you generally just have one tenant in that property, whether it be a family or whether it be an individual. But with multi-let, you then have multiple people renting different rooms within that property. Now, in a multi-let, you could either have shared facilities like kitchens, showers and bathrooms, etc. Or you could have individual units that each have their own showers and bathrooms, and sometimes even their own kitchens, and even sometimes their own little lounge dining area. So depending on the type of strategy and the type of rental income that you want to achieve, you can go with any one of these options. There are multiple options that you can go for, like I've just explained, but that's up to you to decide which is the best option for you. So that's multi-lets, using a strategy where you have, say, 10 rooms in a building, and you're renting those 10 rooms out to 10 different people. Now, for me, this is a very, very risky type of investment because of multiple factors. And the risks here you need to understand. And if you choose this particular strategy, you need to always be on top of your game. Know that either you or your property manager can regularly go into the property and make sure that things are still okay. Make sure that your tenants are fine. Make sure that they are not interfering with one another in whatever way. And make sure that they are not stealing each other's food because it's a shared kitchen. Make sure that people are not breaking things. And make sure, especially on the costing side from your municipal costs, that one tenant isn't using more electricity and water than the other. There are different ways that you can manage this. It is complicated, and these are the things that you need to understand if a multi-let is your strategy. And these are the risks that you need to mitigate. I personally, again, I do not really like multi-lets, but in some cases you have to go that route because of the size of a home or size of a building, and the building itself lends itself to a multi-let. So if that's the route you choose, you need to be careful and make sure that you manage your property directly and regularly. Be there all the time, or make sure that your property manager is there all the time to make sure that things are running reasonably smoothly. Okay, the next one is student accommodation. Student accommodation is similar to multi-let in that there are multiple people in your building and there are shared facilities. Now, there's a couple of things that you need to know about student accommodation. Obviously, you need to know things like the regulations that are behind student accommodation and what the Department of Higher Education wants from you. There are certain sizes of rooms that you need to have. With a single person in a room, I think it's 8 or 9 square meters. With 2 people in a room, it's about 14 square meters. With 3 people in a room, I think it's 21 square meters, and so on. The more people you have, obviously the bigger the room needs to be. There are other things like, I believe now you are not allowed to have double bunks anymore. Each person has to have their own single bed, at least, maybe a 3/4 or a double, whichever you choose, but they cannot have double bunks anymore. The size of the room is important, and then there's the size of the unit itself, in terms of the size of the shared accommodations, the lounge dining area, the study areas, the kitchen areas, etc. Then there's also a certain number of the limits that you can have, and there are certain limits where you need to have parents that will look after the place. So not just the place, but also the people. So you need to have those caretakers that will look after not just the physical site itself, but also the students that are in there. You need to understand the regulations and go and study them. I cannot, in this short course, go through all of those regulations with you. I've just touched on a few now. So the risks there, again, same as multi-lets. People can be interfering with one another. One person can use more electricity and or water than the other, etc., etc. And again, you need to manage this portfolio very, very carefully. All right. The next one is commercial. So on commercial, we're talking about things like office space, retail, industrial. Now, if this is your strategy, you need to have a massive team around you, because commercial is much more expensive and much more complicated than residential and or student accommodation. I've been in the commercial game for about 20 years now. And within those 20 years, I've probably only learned about 20% of what there is to know. Because I've always had a big team around me: asset managers, property managers, retail managers, and so many people, architects. You just need a big team. You need a legal a team, you need a financial team, a tax team. There's just so many people that you need around you to manage a commercial property, especially retail. Because in office, you could have a multi-let office space where there's more than one tenant, or you could have a single tenant. In retail, there's almost always multiple tenants who want plenty of things from you. Retail is the glamorous part of property, but it's also the most difficult of tenancies to manage. With retail, commercial, office, and or industrial, you are now dealing with businesses. You are no longer dealing with individuals or families. You are now dealing with businesses. And as such, much more complicated things come into play. Things like VAT. You now have to be registered for VAT. Because when you are invoicing a business, they will want you to be VAT registered and invoice the rental with VAT so that they can claim the VAT back. And that's just one of the many complications within the commercial space. There are commercial rights that you need to have, which are much more complicated to manage in terms of zoning, etc. Environmental impact assessments that need to be done, and so on. And we'll talk a little bit about that in the next section, which is developments. So, from a commercial perspective, number one, a big team. Number two, understanding the rights that you need for a commercial property. Number three, you need to know how to finance these kinds of deals. With retail, with residential, much easier. You go to the bank, you say you've got a residential property, you want to buy it, you can either buy it in your own name, you can buy it in a trust or a company or whatever, but it's generally much cheaper than if you go commercial. When you go commercial, more often than not, the bank will require a much bigger deposit from you. They will ask you up to 60% sometimes deposit, depending on the risk profile that you and your company have. So it costs a lot more. It requires a lot more input from a capital perspective from your side or your investors. And the banks look at it from a much more risk. They look at the risk profile much more carefully when it's a commercial property. Don't get me wrong, I love commercial. Commercial is, for me, the be-all and end-all of property investment. Because of my history in commercial, I understand it. I understand how to deal with commercial tenants, with businesses, and I understand how the financing works. And my 20 years of experience has taught me how to manage a portfolio that is based on commercial investment and my commercial strategy. That's not to say that that's my only strategy. You don't have to just have one strategy. You can have multiple strategies, but then you need to understand those strategies. You need to understand the inner workings of them. You need to understand how to finance them, because each one of these strategies should be financed in a different way. Okay, let's talk about developments. Developments is probably the most complicated, because developments encompass all of the different strategies from an investment perspective. You can either go residential, single use, you can go residential multi-let, you can go buy to let or build to let, sorry, you can go build to sell, you can go build for commercial, you can develop retail, office or industrial, you can go in a whole range of different student accommodation, a whole range of different strategies combined with that development strategy. However, when you develop, generally you're developing for sale. Most people who develop for sale and not to hold. However, if you're a developer, one of the beautiful things about being a developer, especially if you do things like residential or commercial office that is split into different components, where there is a strategy of having not just single units, but where it is in a complex. And you can then own individual units within that complex, where other people own damn it, what's this called? You can in developments, you can build complexes where there are multiple units and then register a sectional title scheme. Now, with a sectional title scheme, you are in a complex, for example, where there are 50 residential units, whether it be an apartment block or in a complex that is walled and each unit has its own little land, so they're single units. And each of these units can be in a sectional title or they can have individual title. But in a block of flats or apartments, you cannot have individual title. It has to be sectional title. So you now have all of these units, and the beauty about developers or developments is if you're a developer, you can build a block, and let's say your profit margin on that block is 25%. We can only hope. You then take that 25% and you can either take the cash out, or you can take some cash out and hold onto some of the units, or you can hold onto all of the units and take no cash out. In this way, you can then build your property portfolio with the profit you make on every one of your developments. And in that way, build your property portfolio. I personally love this strategy because you bring other people in on the development, you're using other people's money, you're building a development. Obviously, the development has to be feasible, financially feasible, and it must be profitable. So if it is profitable and it's financially feasible, and let's say you like I said, your profit margin is 25%, you can then hold on to 25% of those units. Now, I like this strategy because, like I said, you're using other people's money, you're in control of the development, you're making it exactly the way you want it to be, or building it the way you want to build it, and then you hold on to some of the assets, some of the units, and then build your property portfolio. Isn't that a beautiful strategy to have? I love development strategy. All right, let's talk about the last two options, back-to-back and a lease option. Now on back-to-back, basically there are different back-to-back type strategies and there are different lease option strategies. So back-to-back, you could purchase a property, and before you take transfer, you on-sell it to another buyer. So you put in an offer to the seller, but you already have another buyer, and the margin that you make is your profit. So you buy for $1 million, you sell for 1.2 because that's the market value. and you found that buyer, and you can then do a back-to-back transfer. And sometimes even, like we're currently busy working on a deal at the moment, where our seller has agreed to sign the property over directly to the new buyer. So it doesn't even go through our entity. It goes straight from the seller to the new buyer, and our profit margin is 200,000 Rand. Now, sometimes the receiver will look at that and go, hold on a minute, this is a dual transfer. And you then have to pay, if necessary, transfer duty. But if it's under R1 million, as we've already spoken about, you don't have to pay transfer duties. So then you don't have to worry about it. But sometimes the receiver will come in and say, hold on, you need to pay transfer duty for this transfer and then again for that transfer. So just be careful again, talk to your attorney, talk to your structuring accountant, your tax consultant, and make sure that you don't fall foul of the law when you try and do back-to-back deals. The lease option deal is where you take a lease and you then let it out to somebody else. Or you could even use the strategy where you rent out from the landlord and you pay them a fixed rate. But then you use Airbnb as an example in order to generate much, much higher income. Now, obviously, the risk of the strategy in either way is that you don't find a tenant or you don't find Airbnb clients. Then you have to pay the rental to the landlord. The beauty about it is you don't have to raise the capital in order to buy the property because you are renting from someone and you're then renting out to somebody else. But like I said, the risk here is that you need to pay the landlord regardless of whether you've got a tenant or not, regardless of whether you found somebody through Airbnb or not. So that's the big key here and the big risk. But the beauty about this is the margin that you can make on the rental income without the risk of taking out a bond on a property. All right, so I think at this point we'll take a bit of a breather and then we'll go into session number 4 and we'll talk about area, property and finance. This is Nigel Adriaanse signing off for the Enterprise Development Property Fund.
Thank you again for joining us on this day 15 of our 50-day property challenge. Watch us again tomorrow as we continue this journey with Matt L. and Jared Ricketts.